Kia ora koutou, everyone. Hello, my name's Peter Kelly. I'm the Chief Executive here at Central Otago District Council, and I'm joined by
Julie Muir. I'm the Group Manager for Water at Central Otago District Council.
And look, we're here to talk to you this evening, over the course of the next few weeks, about Southern Water done well. And that consultation has opened up. It opened up on the 9th of May and it closes on the 6th of June. And we genuinely want as many people from our district to have a look at it, write to us with their submissions so we can inform, so the councillors can be informed when they make their decisions. And Julie and I will just talk to a few things about this consultation. So next slide, Wayne. And so really, how did we get here? So it's really interesting, that backstory to this. And you might remember over the time of the previous Labor government with the Three Waters reform, which they were pushing as a solution to this. Obviously, National, when they came into office, said, look, we don't agree with Three Waters reform as its current form. And so we're going to repeal the legislation and we're going to introduce our own. And they did. So they've introduced local water done well. And the reason that successive governments have had a look at this and are now wanting to address it is fourfold, as you can see on the screen. Part of it is we have rising water service costs, and we can talk about why that's happening. We have ageing infrastructure, and this is writ large across New Zealand as well, and it's particular to us in some parts. There has been historical underinvestment in asset renewals and maintenance. And look, you only have to look at the news most nights and the news that comes out of some big population centres in New Zealand, where this is clearly evident. And right now also we have an increased regulatory oversight. We have a water regulator and making sure around drinking water safety. A lot of that fell out of the Hawke's Bay incident of a few years ago. And we have more rigorous environmental standards. All that combined means that we have to rethink how we deliver water services now and going into the future. Next slide, Wayne.
So what does the government expect from us? So we have to develop a water services delivery plan that we need to submit to government by the 2nd of September. And in that we have to identify how we're going to help address New Zealand's long-standing water infrastructure challenges and how we're going to develop a model that works for our community and it meets our new regulations and all the requirements around that within an expected time frame. So we have to have achieved that by the 1st of July 2028. We need to be meeting all of the standards and be financially sustainable. So that means we're raising enough, getting enough income from the charges to cover all of the requirements that are now in place.
Yeah, and it's fair to say that, you know, the timelines for this piece of work is actually quite tight because the government have also said to every council in New Zealand that delivers water that on the 3rd of September of this year, you have to hand in a water services development plan, which tells the government how you, as a council, as a region, are going to deliver water services going into the future. So this is why we're consulting now, because we're having to produce that plan as we speak. And to nail that plan down, we need to know what the preference is across the community. Next slide, one. So as we work our way through this, what are the things that we had to consider? And we're still having to have a good think about some of this stuff, because right now we're in the process of what's the community think. We think we've got a really good proposition, and Julie will talk to that. But at the same time, we're going to have to start working on our water services development plan and draft that up and present that to the government in September. So some of the things we have to have a think about is the financial impact on ratepayers, and the consultation talks to this in a bit more detail. It's about financial sustainability. There's also a little bit about we have to make sure things are affordable, but the driving force behind this is financial sustainability for meeting the levels of investment that are going to be required. Operational and capital efficiencies. We think if we get this right and partnering up with others, we think we can generate those efficiencies. That means some of the options are going to be slightly cheaper than the others. The regulatory requirements, Julie sort of touched on this. The regulatory requirements have changed. We have a water regulator now. We have the Commerce Commission who's going to be looking at the pricing mechanisms. That whole environment means how we used to deliver, pay for water and all that sort of stuff a few years ago is no longer relevant in this current context. cost sharing across ratepayers equally to what does that mean if we go into a partnership with other councils in the CCO? There's also the environmental, social and cultural impacts, which are more and more sort of prevalent that we have to consider when we think about the delivery of water services. The asset value of, what is our asset value for what is it?
It's in the hundreds of millions of dollars.
Yeah, this council has $1 billion in assets, and you multiply that by some of the other councils in the region, and water is probably close to 50% of that. So it's a lot of money tied up in our assets. Debt levels, of course, when you fund big capital, you typically fund that out of loans. Your renewal, your operating is paid for out of rates, but you typically invest for the long term in your big capital items. And planned capital investments is the areas we've had to think about because we have to document that in our plan. And then what's the best options for funding opportunities for that? And again, we can touch on that a little bit later. And what's the borrowing levels that we can go to fund our upgrades? Because all councils are limited as to how much they can borrow. Their debt to revenue ratios is something we have to report against every year, and we're not allowed to breach those.
So where to from here? We've started the conversation in our long-term plan, but we're now getting into a bit more detail with our community around what those options are. So we've got 3 options that we are looking at. The first of those is a jointly owned council-controlled organisation. So that would be jointly owned between Waitaki, Central Otago, Gore and Clutha councils. We're also looking at having the option of a standalone council-controlled organisation. So in that, it would just be Central Otago District Council, and we would set up a separate council-controlled organisation where our 3 waters would be operating from. And then the current operating model that we have, where we have an in-house business unit that delivers 3 waters within council. So even with that in-house business unit, we are required under the legislation to ring fence that and have separate financial reports. It would be a separate annual report, annual plan, strategic documents. It's all going to be kind of separated off from council. So while it's we deliver in-house at the moment, it's not exactly the same. It would be different under this model.
Yeah, and look, I'll just touch on a couple of things here. So council-controlled organisations, that's new for Central Otago District Council because we don't have a CCO. They're quite common in other councils around, and essentially what they are, they're companies. They're set up like a company, but the shareholder is the council. So council retains ownership. And so in a jointly owned council-controlled organisation, when we talk about those other 3 councils, we'd all be equal shareholders in that council. That the collective group of councillors would appoint a subcommittee, and they would then go through the process of selecting the directors and the chair of the board. And then that board would then employ the chief executive and all the workers. So it's sort of configured like a normal company in that sense. And it reports back to the councils as their shareholder. The legislation is pretty clear, can't be privatised. That's been done in the legislation. They're not profit making and they don't return a dividend. So you don't get the Aurora sort of thing that happened a few years ago. It's any money that goes back into the water services entity, whatever CCO it is. And equally, if it's just a standalone council CCO, it's the same sort of structure. It would just be a council would be the 100% shareholder.
And I think as you touched on before, Peter, the Commerce Commission will have oversight over these organisations. They will be regulated as in the same way as the electricity industry is.
Yeah, definitely. In some of the conversations we've had with government officials as we work our way through this, they have said if you go to the in-house business unit model, the level of supervision, auditing over the top of that would be intensive and intrusive. And so for a small council like us, the in-house business unit would be extremely difficult. And in fact, what the legislation also says is that on the 3rd of September, when you submit the Water Services Development Plan, the chief executive has to personally attest that the plan that they are submitting is achievable. And I think there'll be a number of councils in New Zealand who, if they were to put option 3 down, the chief executive, myself included, would be challenged in the current thinking to be able to deliver an in-house business unit option in its current form. So what's this going to cost us? Well, if I go back to the beginning, water is not going to get cheaper for us. The simple fact is the level of investment that's going to be required over the next 9 years, just in our long-term plan, is over $300 million. You multiply that across the other councils, you multiply that across New Zealand. Right now, the average home connection is paying about $1,445. But by 2034, some councils, the Three Waters rates will be more than 3 times higher than they are now. With the modelling that we've done, based on the best numbers from our current long-term plan with ourselves, and also with those partner councils looking at theirs and getting some external analysis of those numbers, what we're sort of forecasting is right now under option 1, the joint council CCO is in 27-28. And why is that year important? Because in our mind, if we establish a CCO, we would like to establish the CCO on the 1st of July 2027. And so that's when you'll start seeing changes. So on current forecast, we're anticipating that under option 1, the average connection would be 2,645 and rising to 3,775 over the course of the next 9 years. Option 2, you can read it for yourself. It's just a bit over 3,000 and then climbing to 4,200. And then in option 3, the in-house option, 2,780 climbing to 4,047. Well, these are what the numbers are saying to us right now. So the cost is going up. In our professional opinion, we believe option 1 is the least expensive option for this council and for the group of councils that we're partnering up with. And we've only priced in about 1.5% in efficiency gain, whereas from a regulatory environment, the people we've been speaking to about this work program, they believe, as what happened in other sort of utilities, that you'll see greater efficiencies. And so our conservative saving of 1.5 is likely to be really conservative. And in fact, we're likely to see more efficiencies, which will help us drive down the cost, which is all about the scale that we're trying to achieve by partnering up with others.
I think just to clarify too, when we talk about water costs here, it's water and wastewater and stormwater. So that's the 3 waters altogether. It's not just the drinking water. So when we talk about our household charges, a jointly owned CCO will provide a slightly lower price path, but it's generally within that range that our internal business unit would be. And then the standalone CCO is likely to be more expensive than an in-house delivery model. And part of the reason for that is if we have a standalone CCO, which is just Central Otago on its own, you're going to have higher overhead costs because you're going to have to duplicate a lot of the systems and support services that we have within council, within that standalone business unit. So it's less cost effective, whereas when you do that across all 4 councils in a CCO, it gets more cost effective because you're sharing those overhead across more councils.
Next slide, please. And debt to revenue, there's one more slide, but this one I'll talk to first of all, which just says, right now, councils are legally constrained about the level of debt. Central Otago District Council hasn't had a history of debt because it's not something we've had to worry about. It's something we worry about now, and with our capital costs. And so right now, our debt to revenue is 175%. So you can see that's the green straight line running across the page here from left to right. That's where our current debt levels have to be below. We're well below that at this present point in time, because that's probably about, top of my head, about 130 million in debt. We're sitting at about probably 40 to 50 million in debt over this next few months. So we're shy of it. But what we're seeing is with the level of investment that we're going to have to do in the 3 waters, is we could not do that level of investment in an in-house option on our current debt threshold of 175%. So what this council has done, it got a credit rating from Fitch. Fitch has rated this council as AA+, so that's actually really good. So what that means is with that increased credit rating, that means we can access borrowing at a slightly lower rate. So it's cheaper in terms of interest we would pay on loans. But it also means that we can increase our debt to revenue ratio. So now we go up to 280%, which is the red line across your page. But if you look at that, then you'd say the yellow line is probably about 250%. That would be a little bit of a self-imposed limit that councils would probably put on the organisation, so you don't go over that threshold. And what the other graphs show is that under the various options, so if we just looked at option 3, an in-house business unit, you would see that under option 3, by 25-26, we'd start breaching our current debt thresholds. And as we carry on, we're starting over the course of 23-24, getting up to 200% of our debt limits. What that really means for a council like us is that, and you'll see it in the next slide, but just not yet, but we end up being a council that has to borrow a lot of money to do a lot of water, but it doesn't leave us much to do a lot of else, other stuff. The other line you see is options 1 and 2 as a CCO. It peaks a little bit, but then we join the joint CCO or the single council CCO. And you see, because what happens there is that under the debt ratios, under the new government policy, when you establish a CCO, then you can access up to 500% of your revenue. And they're really doing that because they want councils to really invest significantly in their water assets over the next 5, 10, 15 years. And the way to do that is to enable them to access loan funding and separate that out from the rest of the council business. So it's only if you create a CCO will you have access to higher borrowing limits. Otherwise, as you would see, we'd be limited to what we currently have here, which would be quite restrictive in the years 2030 and beyond. And when I talk about debt, this is what I'm referring to. So at the 2034, 2035, you see our debt in water is going up to approximately $300 million in current forecast. That other blue band you see is debt that we accrue across the rest of our business. So when we upgrade our roads, when we have to invest capital in our bridges, there's a significant bit of debt there and that type of infrastructure. And the green is the headroom that we currently have, so that our capacity to incur more debt. But without any intervention and without creating a CCO, we quickly start hitting sort of peak debt. That means all we do is we do a lot of water, we do a little bit of bridges, and we might mow a little bit of grass because we won't have the funds to do much else, because that sort of debt would require a lot of servicing over a lot of time. And so the CCO option just gives councils greater headroom, and then you can loan fund out into the distance.
And so what happens with that debt when a CCO is set up is the debt that council's carrying against the water assets would move across to the CCO, and they're able to then fund those big infrastructure projects that have a life on them of about 50 plus years out over a longer period of time and pay that off over time, instead of the people who are paying the rates today paying a great large share of the cost of those projects that are going to deliver benefit to future generations.
Yeah. And it's only right that people who are going to benefit from the infrastructure also pay for the infrastructure. So going forward, all those people who come to the district and utilise the services, it's only fair that they also contribute to the paying down of that debt. Yeah, so look, that's really Southern Water done well, and a very quick soundbite. But look, can I encourage you to go to our Let's Talk page on our website, and there you can download all the information. It's got the financial estimates done by Morrison Lowe that support our thinking, and there's a number of frequently asked questions and some other literature in there that will help inform you as to what we're talking about. As I say, the consultation's open until the 6th of June, D-Day, historically and in the literal sense as well. But we really genuinely want people to get out there, have a look at it, and tell us what they think. Talk to your friends. If you need a hard copy, come into the service centres or into the libraries and we'll be able to print one off. But look, please take the time to have a look at it. It's such an important subject. It's been kicked around by successive governments for the last few years now. We need to resolve this because there is nothing more important than water and the infrastructure that supports that. So this is the opportunity to have your say so councillors can make an informed decision in that late June, early July period. And look, if there's any questions, we're happy to take questions. Equally, if there's no questions, nothing in the chat group there, one?
No, here's the chat here. So,
Very good.
do you want to have a look at the Let's Talk page so people can see?
Oh yeah, can you bring that up?
Yep.
Yeah.
So there's a lot of information online about this, and it's a really complex issue to get your head around. So I think I'd really encourage people to read the information that's there because you know, we get it, we get some feedback where we pick up people haven't quite understood really what the challenges are that we need to address in this plan that has to go up to government.
So if you just scroll down a bit, Wayne. So you can see the consultation document there under the important documents. And then the other two documents below that are the Morrison Low financial modelling and assessments done on our council and the other three councils. And then there's an information sheet there, your way, and the timeline. And there's some, as we scroll down a bit further, you'll see frequently asked questions. Mythbusters is a good one to have a look at as well, to understand what it is, what it isn't. The mayor has the video explaining what we're doing. In fact, all four mayors have videos that we're looking to partner up with. And look, I think that's probably it. So there's a lot there. So do take time to have a look at it. And we look forward to reading your submissions. Thanks everyone for listening and for taking the time to watch us at some date in the future.